that you need to prove is you can affect the relevant activities. All right? So you need to determine what the relevant activities are. And those are the activities that affect the return of the company. We'll look at that definition just now on the next slide. But that is very important, all right? Because if you can control, let's say you are given voting rights in respect of all the administrative tasks in a company. Yes, you control the admin. Does that eventually affect the outcome, the final result, the profit level of that company? No, it doesn't. So that does not give you control. So firstly, your control, your power that you can exercise must be over the relevant activities. Very, very important. Okay, so you can see there's already a second area that we need to investigate to determine whether we have control or not. And then it says, through its power over the investee. And here, that is the part that is very similar to what IAS 27 said before. Here you're going to have a look at, what are my voting rights? What is, do I have potential voting rights? Is there possibly a contractual agreement in place that will give me control over the entity for a certain period or, continuously? All of those things will play a role. What are the power instruments and how do they give you control? That comes from IAS 27 or is very similar to IAS 27. All right, so I think what you need to do is you need to pause this lecture and just go and read through the new definition of control and familiarize yourself with it and make sure that you understand all the concepts, because that's what we're going to be discussing in a short while. Then some more key definitions. The parent, an entity that controls one or more entities. So what does that mean? You don't have a parent relationship if you have an associate or a joint arrangement. You cannot be a parent. Then you are called an investor. A parent controls another entity, and that entity is called the subsidiary. So if there's no subsidiary, there cannot be a parent. So the parent-subsidiary relationship, they always go together. Then power. What does it mean to have power? Before I go look at the power instruments, what are power instruments? Okay, and that will be affected by what is power. Okay, power is the existing rights that give the current ability, look at the words current ability, to direct the relevant activities. Do you see what we're saying here? Okay, so existing rights. So what does that mean? They must be substantive. They must be practical to exercise. They must be possible to exercise. They must be valid. They must be substantiated. Can you see what we're saying? All right? Existing rights that give the current ability. When you prepare the consolidated financial statements, can I use these power instruments or not? Okay? Because if I cannot, for whatever logical reason, and that's the nice part of IFRS 10, you will see that it takes into account the logic and the economic circumstances as well. If I cannot exercise them, I cannot take them into account. The current ability, and then instead of the word govern, they've used the word direct the relevant activities. All right, now let's have a look here. Protective rights. What are protective rights? Ladies and gentlemen, if you go into a contract with someone, and they always make jokes about the fine print in the contract, okay? Those fine print items normally protect some of the parties in the contract. Do you agree? But the issue with them is that they only kick in under certain circumstances. For example, if I say, I'm entering into entering into an agreement with you, okay? And I cannot enter into any other agreement that is similar to this agreement, because that protects the other party with whom I've entered into this arrangement. Do you agree? Now, that will only become a protective right to the other party once I try and enter into another contract with someone else. So, those are basically limiting rights or limiting rules that limit one or two of the parties that they cannot act in a certain way. And that's why they basically only become relevant and kick in under certain circumstances. All right. Now, what's the important part? Why are we even talking about protective rights? Let's firstly read what it is. Rights designed to protect the interest of the party holding those rights, without giving that party power over the entity to which the rights relate. So what does this mean? you can just summarize it as follows. Protective rights do not establish control. All right? They do not establish control. And that's very important to remember, because what did I say earlier in the lecture? Control is ultimate. And this will only be giving you a certain right to direct certain things under certain circumstances. Can you see? So it's not ultimate, it's not unconditional, it's subject to. And that's why that cannot establish control. So all that you need to know, protective rights do not create control, or they don't establish control. Then lastly, very important definition, relevant activities. Ladies and gentlemen, activities of the investee that significantly affect the investee's returns. Can I stand here today and say to you, it's this, and the others you can just ignore? No, I can't. Why can I not do that? Because the relevant activities will differ from one entity to another. What must you go and have a look at? What are the activities of the entity? You will find that there are certain administrative activities, there are certain marketing activities, distribution, production, etc. Now you need to ask yourself, what is this entity incorporated to do? And those activities that are linked to what it was incorporated to do, the main goal and purpose, the day-to-day activities of the entity, those are the relevant activities. Why is it so important to determine the relevant activities? Because you need to determine whether you have power to direct the relevant activities. I want to say to you that if you have power to direct the irrelevant activities, no control. That's why we need to stay and stick to the relevant activities, because they affect the outcome. Can you remember what we started with in the definition? We said there has to be exposure to variable returns from this entity. Do you agree? Now, if those activities don't have a direct link to the outcome, to the returns, then what are you controlling effectively? And that's why all of those items basically form one component, and that is what we call control. Now, what are we going to discuss? How to determine whether you have control, what is the process that you need to follow, what to be on the lookout for, and that's what we're going to do in the next chapter. Ladies and gentlemen, in chapter 3, we're going to have a look at how control is determined, because now you know what the definition of control is. Let's move on to slide number 16. What is control? All relevant facts and circumstances must be considered. When you read through IFRS 10, you will find that that is a theme that basically comes out in the standard all the time, is that look wider. Don't just look at the information, take a step up. And look down on the situation and say, what is really happening here? Take into account all the facts and circumstances that are relevant to the determination of control. So the standard basically invites you to look further and look wider. All right, consider the definition as discussed before. Now, obviously, we start with the definition of control. You know what those elements are: the exposure, the ability to affect the outcome through the power that you have over the investee. Now, if you look at the third bullet point, that is probably the most important area. Now, ladies and gentlemen, what's important here? All of those elements, power, exposure, and ability, must be present before you have control. And they must be strongly present. They must be undoubted, okay? So those are the three areas that you need to determine should you be given a question to determine whether there's control over another entity. Remember what I said in the first chapter. This is actually a very nice opportunity for you to be tested on a discursive type question. Discussion, theoretical question. Can you interpret the facts? Can you make them relevant to the specific definition? So if I were to test you on IFRS 10, I would give you a theoretical type question on, does this company control another company? All right, and test you on your ability to interpret. Now, the first thing that must be, power over the investee must be present. Secondly, the exposure or rights to variable returns. And remember the variable returns, because otherwise they can't be affected by how you control. Do you agree? Because the more you control, the more you have an effect on the variability of the returns. Do you agree? The bigger say that you have, the bigger impact you have on the returns, and the variability can then increase in the returns. So I almost want you to make a note here by saying that the more power you have, the higher the variability in the returns. Okay, so that's very important. Okay, then the exposure we've spoken about, and then the ability to use your power instruments to affect the amount of the investor's returns, good or bad, profit or loss, doesn't matter. Okay, so now let's first look at the first one, power. This is the one that you'll like to discuss because this is similar to IS 27. So what are you after when talking about power? You're looking for your power instruments. All right, so take a highlighter in a question and highlight the instruments that you think you can use to direct relevant activities. Forget the rest first, okay? So look out for power instruments. Let's have a look here. Power over an investee arises from rights. So what is a right? It gives you the right, the ability to do something. Do you agree? So whatever gives you that right is a power instrument, all right? Which can be straightforward, for example, voting rights, or more complex, for example, per contractual arrangement or agreement. Protective rights, we've spoken about, they do not provide control because there's no power over the investee because that right or ability is subject to certain circumstances and therefore not unconditional. Let's move on to slide number 17. An investor must be exposed to or have rights to variable returns from its involvement with the investee in order to control it. All right? So this means that no party that has a fixed outcome, like a fixed preference dividend, all right? No party like that. If you're a debenture holder, what are you getting? You're getting 10% interest on your debenture and you're getting your capital paid back. Does it matter how the entity performs financially? No, you don't have control over that entity. Can you see that the outcome, your returns must be variable? You must have that exposure in order to be able to affect it. Can you see? So if the exposure, the outcome eventually is fixed, there's no risk. So what are you going to try and control? Whether you control or not, the returns will be the same. No control exists. All right. So I'm trying to prove to you here that if you don't have variability, you won't be able to see the effect of your control, the impact of your involvement on that profit, if that profit that you are earning is fixed. Because then we don't know, was there an impact due to your control? And it's for that exact reason, whether you have control, whether you have an impact, that you must consolidate that company, because you only consolidate what you control. And that means you only consolidate what you can affect. That's the important thing. That's consolidation. All right. Not what you own. Ownership is not the reason for consolidation. Have you ever asked yourself, if we consolidate this company, we only own 60%, but we control 100%. Remember what I said earlier, control is ultimate. You either have it or you don't. Do you agree? So we own 60%, but we control 100%. So how much of the assets and liabilities do we bring into the financial statements? 100%. How much do you bring regarding revenue and expenses? 100%. Why do we bring in 100%? Not because we own 100%, because we don't. We own 60%. But because those items are under our control. And that's the concept of consolidation. All right. Let's have a look here what we say. An investor must be exposed or have rights to variable returns from its involvement with the investee in order to control it. These returns must have the ability to vary as a result of the investee's performance and can be positive, negative, or both. Okay? The investor's power must be used to affect or influence these returns. Now, ladies and gentlemen, there's yet another angle that you must go and explore. Is there a causal, C-A-U-S-A-L, is there a causal relationship between what you do and the returns? All right? So once again,